A very good day for you, good evening, depending on where you're watching this lesson from. Today we are delving deep into the platforms that we loaded so that we can begin to understand the platform. This platform is a place where we have a chance to mark, write different things. We have the opportunity to view the price action of the market. We can look at our different assets and determine where is it headed, where is it coming from, what is it depicting, and we're able to make our decisions in the future based on understanding the various things that we see on the platform. So welcome to Forex Trading module. We're in module 2, candlesticks and time frames. We want to understand candlesticks and understand what they are all about. Indeed, there's something to understand here so that we may be able to move fast into trading, and we move into making decisions, taking up positions, making orders, and making the money. So Forex trading, what is it about in terms of the candlesticks? What are the candlesticks for? What do they show us? Now, that's what we're going to cover in this lesson. We're also going to cover their relationship with time, because candlesticks are all about time, my friend. Time is the most important thing here when we talk about these candlesticks. They is what they do, and we're going to understand what they are all about. So let's go ahead and read that Forex traders assess the next moves a currency pair is about to take. Taking position often by looking at charts on their trading platforms. These charts show price action, the repeat of well-known chart patterns and other factors. There are many kinds of graphs that give information, but the most commonly used are, we have line charts, we have OHLC charts, we have candlestick charts, we have Renko charts, and we have point and finger charts. Okay, those are the different charts. Now, so that I can just break this down for you. You remember that in the trading platform, there's a feature up there that allows you to choose how you want the particular information of price, how you want it portrayed. Would you like just a line? Would you like, the candles? Would you like? There are the various kinds that are mentioned there, but each of these have their significance. Sometimes you only want to look at the average movement of a certain asset, so the line is quite appropriate. But when you want to see some more detail, you will move to other details, like you want to have a look at the OHLC charts. The OHLC chart will show you the opening. That's for the O. The H stands for the highest point in that particular time or that particular place, and then you have the L, which stands for the lowest point, and the C is the closing. So OHLC charts, they show you the opening, the highest, the lowest, excuse me, and of course they show you the closing. So there are many kinds of charts, like you can see there, but we want to understand in this particular session, what are these candlesticks? The candlestick chart, what kind of a chart is it? What is it all about? And you're familiar with it, you've seen it, but you've not known what it deals with. This is the time. So the last paragraph there says the graph that is the most used due to the amount of information it carries is the candlestick graph. So come along, let's move into the candlestick graph, and we will see what it has. Now, on your screen now is the line graph on the top, and then you have there below you have now the candlestick. This is how you determine the difference. Yeah, that's how you can know which one is which. Then on the extreme right, up there is also another kind of candle that is, or rather, not a kind of a candle. It's a kind of a graph. You can have a graph with this kind of a depiction. But in all these things, you need to understand that candlestick method is the most used. So let's go into candlestick and understand it. Now, candlestick, this is the history. Candlestick method was created by a Japanese trader called Homa Munehisa at the Dojima rice market in the 1700s. Imagine, this candlestick has been used over the years. You know, candlestick did not just, it was not invented by some guys in the recent past. These candlesticks that you're learning, and you've seen them, you've seen images, they were invented by these Japanese many years ago. Let's have a look at the man. Okay, maybe we don't need to look at the man now. Right now, in your free time, you can just find out about him. But it's just a history of what he was doing and how he invented something that is used even today. It's an amazing thing. He invented something that is so the market depends, or rather analysts depend on it so much. Now, it involves recording the price action of a certain time in the shape of a candle. Just like a candle has a wick, body, and height, Forex candlestick has all this and holds information of what price opened at, the highest point, and the lowest it traded, and the closed and the price it closed at in a given time frame. So that is self-explanatory, but basically we're saying that one candle, remember, one candle represents a particular time frame. You can decide that one candle will be 1 minute. So in your platform, in your trade, in your software, in the platform, you go and choose the M1, which is 1 minute, or you choose the M5, which is 5 minutes. You have now determined that your candle, the one single candle, will be representative of that particular time unit. If you choose 1 day, yeah, so your every single candle is going to be showing you 1 day. So take that information now and bring it into what we are saying here, that it involves recording the price action of a certain time in the shape of a candle. Just like a candle has a wick, body, and height, the Forex candlestick has all this, and they hold information of what price opened at. So in that one candle, there's the issue of opening, there's the issue of the highest point, and the lowest that it traded in. All right, moving on, so that we can understand this, we need to see the different parts of a candle. Here we go. There are two main parts of a candlestick that tell a story: the body and the wick, or rather the shadow, because some people call it a wick, some people call it a shadow. Now, the body shows the opening and the closing. Okay, the wicks show the highest and the lowest prices of that period. When we look at the period, if you look at the red candle that we have on your left, okay, the highest point is that particular place where you're seeing it's marked. It's marked with. Okay, the highest point. That's that particular marking. That's the highest point. But you have the opening right below it. Okay. Then you have the close of it. That is at the end of the body, the base of the body. Okay. Then the lowest part there, marked low, is the lowest of that particular market, or rather that particular asset within that time frame. I'll go over this again so that you can understand it perfectly. The top of that, the wick, the top of that wick is the highest point that price came to. Then the base, or rather the body, where the body starts, that's the opening, where it started, where the market started for that particular asset on that particular time frame. If you're dealing with 1 minute, when it was at 1 minute, that's where the 1 minute started. Okay. If it went up to that high, that wick, that's the highest it went. If the value went down within the minute, it came to the lowest. The lowest is that end of the wick down there. And if it's closed at a particular time, then that's where the body's base is. So you can see that there's a shape. That's what you call, the first one is called the the bearish candle. Beg your pardon. The bearish candle, the red one here, is bearish because the market went down. Okay, so it started up here. You can see the opening. Okay, then it went high. Okay, then the market changed and it came to a very strong low down below. But the market went up again a little bit and it closed at that particular body where you're seeing the body, the red body. Okay, similarly, when you come to the other candle that we have next to it, we have the one on the right. You have a bullish candle. Bullish means it's going up. So it started, it's opened down there. You can see down there the end of the body, okay, at the base of the base, the foundation of the candle. Down there is the word open. That's where the market opened at. And it had gone low. You can see there below, it had gone to the lowest point, to some low point there. But then it has gone on in the course of that time frame, and it went very high to the high that you're seeing there, the wick top over there. The wick, W-I-C-K. That top is called the wick. That wick, it shows the place that the highest that it had gone as far as price is concerned. And of course, the close is marked there, where it closed at, where that market, or rather that time frame, closed at. So you're seeing that this candle is not just a candle, and you need to understand that when you look at the candle and know, where the market started, where it closed at, you're able to know where was the market playing at that particular time. Were there more people that were bullish than the bears who were defeated, and it closed at a high green bullish status, or was it bearish where that particular asset was selling? People were letting go of that asset. So that's what the candle is all about. And remember that every candle represents a time frame. It can represent a year, it can represent a month, it can represent a week or a day, it can represent 4 hours, it can represent 1 minute, it can represent, so you just go to the platform and you click so that you're able to identify. Remember, there are people who are day traders. Okay, there are people who are day traders. They want the information that will help them to determine things of that particular day. So they will look at candles in the form of hours, and they will look at candles in the form of minutes, and they want to make their trades within the day. There are others who are longer term traders who will take a position, and they want to understand how has the market been in the course of the week, in the course of the month, in the course of several days. They too can be able to put these candles in such a way that even if there were some minute changes or fluctuations or movements of price, they still are able to get a clearer picture of the direction of the market and the trend of the market. Yeah, so that's it. Now you understand that a candle has all that information in it. It shows the highest point of the market in that trend, the opening where it opened at, the close where it closed at, and the low of that particular day or that particular asset within that particular time frame. So it can be a few minutes. You can be looking at a time frame. You can be looking at several minutes, the last 60 minutes. You can click the time frame there, and it will show you the last 60 minutes, one candle. You'll be able to see at every minute what time, what the market opened at and what it closed at. Okay, candlestick colors. Let's go over and say that if the price closes lower than it opened, then it should be marked red or black as it has fallen. Okay, so the price has come down. That's why we mark it red. You can even choose to mark it black. Or rather, you're saying that it is bearish. It has gone down. If the price went up, closing time, then it is marked green or white, which means it's bullish. And there are more people buying than there were those who are selling. The opening point, the highest point, and the lowest point is traded at, and the closing point in a given time frame are shown by the wicks and the shadows. So those wicks and shadows, they show the highest point and the lowest point. Self-explanatory, and it's an easy one. Now, time frames. Let's look at time frames. The candles each depict a certain time, and that's what I had mentioned verbally, but now here we have the notes that the candles each depict a certain time. This can be 1 minute, 5 minutes, 30 minutes. It can be a candle showing 1 hour, 4 hour days, weeks, etc. Time frames are switched so as to zoom in or out on what was happening to price within a certain time frame. You can switch on the platform from looking at a single candle depicting a month, a week, to a candle representing price action within a minute. Remember, we're always dealing with, in the platform, time against price. All right, the kind of trade strategy you use determines which time frame you concentrate on viewing. Long-term trades versus short-term scalping. That's what I had explained, and it gives you the idea. Now, commonly used candle shapes. There are numerous shapes that candles take depending on how the market behaved in a given period. And these shapes are often used to predict what the market is likely to do. The patterns are either single candle or several candles together. What are we saying here? We are saying that this shape, okay, because the different time frames will produce different candles. At what price did the market open? It opened at this price. And then this is what happened. So the particular shape of the candle produced will be a particular kind of a candle, or rather a particular shape of a candle. Now, the next minute or the next time frame you're looking at will depict a different candle, because the price does not remain constant. Are we together? The price fluctuates. So that fluctuation will produce different candles. That's why when you look at the graph, it has, all these are different candles. There are going to be some which are bolder, with no wick, some with a wick, some with a wick below, some with a wick on top. They will be different. Now, that's what we're talking about, and saying that there are numerous shapes that the candles take depending on how the market behaved. Okay. Now, that issue of those patterns, we can be able to put those candles together. Those candles appearing together can mean something. For instance, when you have several candles that all are showing that they are all red and they are all beginning to show a lower low and a higher, a lower high, it shows there's a trend, or there's a certain direction the market is going. Those patterns have been able to be grouped together to mean certain things. Okay, so when you hear that we are doing an analysis and we are using the candles to analyze, there are people who just use candles to analyze the market. They are looking at those particular candles, what shapes are being formed. So there are certain patterns that are formed, and that's what we're talking about here. So let me just carry on and say this. There's something called a doji candle shape. That's a single candle showing something. Remember, I had said something here, that the shape, or rather the pattern that depicts something, can be that pattern or that design, that shape. It can be the shape of one candle, just one, a single candle, and the one candle will be able to say something. Or it can be several candles put together. So we've started with the example of a doji, what they call the doji candle. Doji, I believe, is a Japanese, should be a Japanese name. We said that this Japanese guy in the 1700s is the one who invented the candles, and he came up with different candles. These Japanese, speaking of these Japanese guys, I just remembered about the cryptocurrency, and there's still a Japanese who is missing. The guy who came up with this cryptocurrency, I wanted to call it madness, but anyway, it's a whole serious thing, and the Japanese who came up with it is missing. At least for the one who came up with candles is known, and one of the candles he has is the doji. The doji is a candlestick in which the open price is the same as the closing price. It has no or almost no body. It's a very small body. It has a very small body. You can see the image of it at the right side of your screen. And there's something that it says. Okay, there's something that it's showing. Okay, it's showing a certain characteristic. So when a stock is in a downtrend and a doji gets formed, it means that the sellers tried to take the stock down, but the buyers showed interest and got the stock back up. This signals a possible trend reversal from a downtrend to uptrend. So what now we what this particular explanation here in this PowerPoint presentation is saying is that that particular candle called a doji, it has a meaning. It means that there's a time the market had gone so high, or there's a time it had gone so low, but it still came back to this particular point. That's why it has no body. So the opening, the closing are at par. So there's a tug of war between those who wanted to go up and are buying the highs, the bulls, and those who wanted to go low and they are selling it, the bears. So but they still were unable to sustain the downtrend and just come back to the same place. So that information is coming up from one candle. It could be the candle about what was happening in a day, or it could be a candle showing what was happening in the last 1 hour. You can look at the candle and say this 1 hour is showing that the bulls and the bears were having this kind of a tussle. So therefore we're able to now look and say this shape was that way because of how the market was. This is a signaling that there was there's a possible trend reversal. Trend reversal means the changing of the trend. Okay, that means there is a possible changing of the trend from what it was, how it was heading to now a different thing. So let me carry on with the presentation here and show you a doji, an example of a doji in our platform. You can see there that you had price on the left in a certain way, but it moves. But when you go to the right side, you can see that candle there. That's called a doji, the doji candle. It is showing something. There's something about to happen there. There's a tug of war happening, and the opening and the closing were around about the very, very, very same place. So we can go ahead to another one and look at it. It's called the spinning top candle. The spinning top candle, it's another different candle. You can see the spinning top candle, how it's shaped, and that shape has its meaning. Okay, that shape of the spinning top candle has its meaning. Let's read. Candlesticks with a small body size are called spinning tops. They usually appear during periods of market consolidation. The spinning tops tell us about the neutral character of the market and appear within a narrow trading corridor. The main difference between a spinning top is the small size of the body. The size of the shadows and the wicks usually does not matter. So that's a spinning top. It has there's what it tells us about that particular market. It can be bearish or bullish, as we have seen in that. We can move on to the next one there. It's called the Marubozu pronunciation. Marubozu candle. The Marubozu candle, these are candlesticks without shadows and wicks. You can see they are just solid. Moreover, the smaller the shadow, the stronger the signal. So there's a signal it gives when you see that small signal, that small wick or that small shadow. That small wick will mean something. It means that the price is stuck to those particular price ranges, or that particular price. So the opening was here and the closing was here. So you can have a Marubozu which is bearish and one which is bullish, such that one would depict that eventually the price closed, it closed higher, but it shows you that there was that tag. So I think I can go ahead and say, according to the second paragraph, a green candlestick indicates that the opening price coincides with the low and the close price with the high for the analyzed period. It reflects a bullish mood in the market. Okay, there's a bullish mood in the market. Okay, if the candle is red, it indicates the open price coincides with the high and the close price coincides with the low of the trading time frame. Its appearance indicates greater prevalence of bearish sentiment in the market. So this candle is able to tell us something. If we see the spinning top candle that we had talked about, it tells us something. If we see the previous doji candle, it also tells us something. So these candles are, depending on the time frame we have chosen, they have a particular story to tell. There is something that we are being told by these particular candles, and it's good for us to know what these candles mean. There are very many, we can't know all of them, but knowing some of the main ones will be your key here, so that you will be able to know what is about to happen. What is likely, what does this pattern depict, what does it signal? Okay, so that's the reason why we need to be keen on these candles, and then use the information that we get from the candles with other information that is gotten from the other sources. So we are going to have several things. There's something called confluence. Confluence is very important in trading, that we make a decision not based on just one thing. We base our decision on several things. Candlestick shape is one of the things that you can use. You will take that one thing, but you will not depend on it entirely, or you will not depend on it in isolation. Okay, you will depend on the candlestick, but you will also go ahead and also check a few other things that will tell you the direction that you're supposed to take in the trade. So we've handled a few. There's the doji, we've handled the spinning top candle and what it means. There are others. There's marubozu candle, that is a solid candle there. There's a hammer. Okay, the hammer candlestick pattern is formed of a short body with a long lower wick. You can see the one I've circled here. That's a hammer. Okay, that's how it looks. Looks like a hammer actually, you know, with a handle. The wick is like the handle. The hammer shows that although there were selling pressures during the day, or rather during that time period, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but green hammers indicates a stronger bull market than red hammers. So you can have a red hammer or a green hammer. But this is now showing, you know, the strength of that change that is happening. So remember what we said, that these candles, they have a story. They are showing the opening of that particular time. They're showing the closing. They're showing what was the highest and what was the lowest part of that particular time frame. And here we are seeing this particular one is called a hammer. It's very useful when sometimes you want to make a decision on at what point to enter a trade. You have an inverse hammer, which is the inverse of the previous. The inverse hammer, a similarly bullish pattern, is the inverted hammer. The only difference being that the upper wick is long while the lower wick is short. It indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market price down. The inverse hammer suggests that the buyers will soon have control of the market. Now, I need to interject here and speak to somebody who is getting a bit fatigued now with these candles, and you're wondering, am I going to learn all these candles? No. You need to have an overview of the candles, and then there are those particular candles that you will spot at a particular point. You don't have to look at all the candles, okay, on your graph, but at particular points, you will look at what was happening here, and the candle will shed some light. You'll be able to know what was going on, what was the pull and push, so that you can join the dots, so to speak, so that you can make a decision that is informed, that is dependent on what was. So the price action, what was, is what is being shown to you here. So there's this inverse hammer, and you have seen it is an upside down hammer, and it has a meaning. If you look at that text, you will see the meaning of it. I want to carry on and talk about the bullish engulfing. Bullish engulfing, the bullish engulfing, and there's something I want to show you here, even before you go ahead to understand the bullish engulfing. That we were talking about the spinning top, which is a single candle. We talked about the marubozu, which is a single candle with no wick, no wick below or on top. But now we're moving into bullish engulfing, which it involves two candles. So this one, the shape of it, the pattern involves two candles, and like you can see there, you have you have the smaller bullish candle, or rather the bearish candle, which is red, and then you have the bullish green candle. So when the bullish candle, the large one on the right, is engulfing, it's engulfing the smaller bearish red one. That's what you call a bullish engulfing. So let's read over here. It says bullish engulfing. The bullish engulfing pattern is formed of two candlesticks. The first candle is a short red body that is completely engulfed, no wonder the name, by a larger green candle. Though the second day opens lower than the first, the bullish market pushes the price up, culminating in an obvious win for buyers. So that is the story behind these two candles. There is a bullish engulfing, okay? There is a bullish engulf that the candle of that is the green one that shows the bulls. It is so strong that it has engulfed entirely the previous days or the previous time, the previous candle's height. Okay, so you can now begin to see that these candles have a story. Each of them have a different thing. There is a bearish engulfing, which is now the opposite. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red candle. It signifies a peak of slowdown of price movement and is a sign of an impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. So you can be able to know what's going to happen based on looking at those candles and seeing how they are behaving. We have another one called a piercing line. The piercing line, there's an image, there's a diagram over there for you to see. The piercing line is also a two-stick pattern. Okay, so it's also two candlesticks made up of a long red candle followed by a long green candle. Okay, when you see that, it means it's a piercing line. There is usually a significant gap down between the first candlestick's closing price and the green candlestick's opening. It indicates strong buying pressure as the price is pushed up to or above the mid price of the previous day. So you can see what causes this to be called a piercing line is because of that issue that there's a buying pressure, okay, and the price is pushed up. So all these candles have something that they are saying. We have the morning star. The morning star is a candlestick that pattern which is considered a sign of hope in a bleak market downtrend. It is a three-stick pattern. Notice now we have gone to three sticks, and I hope you're seeing the trend here. We were dealing with a single candle giving us certain information as a single candle. We went on to engulfing. The engulfing candle, engulfing bullish and engulfing bearish, they were telling us some information, but we were looking at two candles. Now we're moving on, okay, to morning star. Morning star, we're looking at three candles. Okay, there they are, about three candles, and those three candles are saying something. So let's read on. The morning star candlestick pattern is considered a sign of hope. Okay, we had read that. It is a three-stick pattern. One short-bodied candle between a long red and a long green. Traditionally, the star, in quotes, will have no overlap with the longer bodies as the market gaps both on open and close. It signals that the selling pressure of the first day is subsiding and the bull market is on the horizon. Now, when I think about Morningstar and I think about this Japanese who came up with these candlesticks, remember he came up with them in a rice market. In this rice market where he was selling his rice, I don't know whether he was selling or he was doing both selling and buying, but being a trader, he was probably doing both. He had a way of looking at the trend. In this rice market, he would look at how many buckets of rice were bought yesterday, and he would have a candlestick shape that gives that information. He wants to see the shape tomorrow. He wants to see the shape the following day. It's almost like a tongue twister. So he wants to see the shape of the candle on different days. And sometimes he uses one candle to depict what might be happening. Then he begins to notice that the pattern can be gathered, or that information can be gathered from two candles. So he looks at two candles and he notices, when I look at two candles, this is what it shows. Then he goes to a level of realizing, wow, like the morning star, three candles can mean something. So you're getting the drift, that when you begin to now be aware what these candles are, you will notice at certain times, sometimes you will just be scrolling and then you will notice, this might be meaning something. So get conversant with these candles, get to know what these candles are, these patterns, and eventually we will move on to understanding different other patterns that are formed. So we have the shooting star, and you will look at the notes so that you can understand what it depicts. But briefly, the shooting star is the same shape as the inverted hammer, but is formed in an uptrend. It has a small lower body and a long upper wick. Usually the market will gap slightly higher on the opening and rally to an intraday high before closing at a price just above the open, like a star falling to the ground. So the name shooting star came from that, and sometimes you will see the trend happening that way. Now we have a chart here where we have very many bullish candle patterns. So all these are bullish. It means that all of them, they are happening when the market, they are happening onto a bullish market. So I think it's good for us to have a little look at them. Let's have a look at them one by one. Okay, candlesticks, here we are. Let's look at them. I hope it's clear on your screen. But the first one there, the first one, bullish candle pattern, is the hammer. We had mentioned it. We went on to talk about the bullish engulfing. I'm on the same row, on the same row. Then the third there is piercing line. We have inverted hammer. We had that one in our presentation. We can go ahead and see the morning star, which we already saw. We have the bullish separating lines. There's the bullish mat hold. There are others that we hadn't talked about, like this one. Then there's the three stars in the south. There's the dumping top. Okay. In the second row there, you have morning doji star. Okay. There's the bullish harami. There's the bullish engulfing cross, bullish belt hold. You have the three white soldiers. You have bullish three line. And the list goes on and on. I'll tell you this for a fact. I'll be very honest with you. Sometimes I don't remember personally. I do not remember some of those candle formations, but I try and just I got myself familiar with them initially when I did the course, but I went ahead now to keep them in my mind, in my sight. So once in a while I will just open this chart, bullish candle patterns, and look at this formation so that I can refresh myself. So please do the same, refresh yourself on these different bullish candle patterns. Now, if there are bullish candle patterns, in the same way there are bullish candle patterns, there are bearish kind of patterns. And I want us to look at the bearish kind of patterns now. And here they are. The bearish candle patterns are now on the screen. And the same way that we looked at the bullish, let's look at the bearish. The bearish, the first one there, we have the hanging man. Very common one, hanging man. Yeah, it has a way of depicting something is about to happen. When you see the hanging man, just know that this is going to be a bearish turn. The market is going down. Another one there, next one is bearish engulfing. Okay, when you see this, it means the bears are having the market. Now the trend is going to go that way. You have the bearish piercing line. You have the shooting star. You have the evening star. All these are bearish. They show that the market is about to go south. Okay, it's a selling time. It's time to sell. The bears are the ones who have it. There is the evening doji star, and you see that doji star in the middle there. That star there. It means that the market is changing, and now it's going to be the bears having the market. Then there's the bearish harami, the bearish belt hold, and the last one on that row is upside gap, two crows. And there were many names from the Japanese here. There was the bearish harami cross. There's the three black crows, bearish meeting line, the dumping top, the tower top, advance block, bearish breakaway, bearish kicking. On the last row there, we have downside Tasuki gap. I have never used this one. I've never noticed it, but I think I'll do a study on it. I tell you what, this is a learning. Forex trading is about learning continuously and becoming better in your skills. Then there's the following three methods. Okay, bearish mat hold, bearish three-line strike, and the list goes on and on. The list goes on and on. Knowing this will only make your decision better. Knowing these candle patterns will only make you a better person. Now, patterns can confirm a coming reversal or continuation of a trend. They can confirm that this is going to carry on or it's going to stop. They can confirm that there's going to be a continuation of a trend or a reversal, a change. Note, candlestick patterns are most useful when used in conjunction with understanding other factors like trend, market structure, location on the chart that the pattern appears, etc. So, like I had said a little earlier, that the whole idea is use those candlestick patterns to confirm something that you're about to make a position on. Use these candles to approve something that you're beginning to see. When you begin to see the market might go this direction or that direction, you can use the candles to affirm what you are thinking and what direction you are about to move into. So there are three things that we mentioned there. We have mentioned that there's an issue of trend. The first step is to check the trend. The first step when you look at a chart, you're looking at the trend. Okay, the first step is to identify the trend. A good trader will check the trend direction. If the trend is bullish, that means it's going up. Okay, he will only look for bullish candlestick patterns. So you look for bullish candlestick patterns when the trend is bullish. Okay, he'll ignore other candlestick patterns and will only try to find the bullish patterns. Okay, so that's how trend now comes into play. Remember, trend now is the market bullish? Is it going up, or is it bearish? Is it going down? So you remember we've dealt, or rather you've seen that we've dealt with bullish candles and then there are bearish candle patterns. Okay, so there's a difference. Now, structure. After finding the directions of the trend, a pro trader will look at the structure of the candlestick pattern to validate by looking at the OHLC. The OHLC refers to the opening, the high point of that particular time frame, the L, which is the low, and the C, which is the closing. Okay, so these values, you look at them. Look at these OHLC values of each candlestick. This step will help traders to filter good patterns from the candlestick chart. So they determine the strength of the candlestick patterns. Now, in essence, what this notes, what is going on in this notes is this: that there are times when the shape of the candle will not exactly be like it'll not exactly be like an engulfing, because maybe the wick was shorter or something. So some of the times when you look like there was a particular pattern about to form but it didn't form, you can ignore those kind of patterns. Look for something which is clear. Look for something that is straightforward, that because the market will behave differently every time. So there's no set thing that the shape of the doji is supposed to be like this. Sometimes it will want to form a doji, but it's a short doji. Another will be a longer doji, etc., etc. So that's what we're saying, that you look at the structure, but you also can ignore some of the ones that are not forming really well. They're not informing your position, and you move on to look for that which is clear. Then you also, as a good trader, need to look at the third thing, which is the location. Okay, so we're looking not just at the trend, what trend they appear in, or the structure they are forming, but also the location. A good trader will look at the location of the candlestick pattern to confirm that either the pattern has formed in ranging market conditions, or overbought, oversold conditions. So you can check the issue of the location so that you can determine whether that pattern is going to be useful for you and useful in what you are seeing and what seems to happen. So in a nutshell, that is what candlesticks are all about. You now know what a candlestick is, the shape and what it means. You know that it shows all those different things, the opening price, the closing price is there, the highest point and the lowest point. And then you know now the patterns that are formed. You can go ahead and download the chart and have a chart with you, which you'll be looking at once in a while, so that you can familiarize more with these patterns that is formed by single candles, sometimes 2 candles, sometimes 3 candles, several candles. Candlesticks are an integral part of charts in forex trading. So thank you for the time you've spent with us understanding candlesticks, and we'll go on to understand another thing in the patterns that will enhance how we interpret what we view. Thank you very much.